Sorry I can't be with you in person today, but it is again an honor to be asked to present the grain outlook at the Bankers Conference this year. I'm Mark Welch, the grain marketing economist with Texas A&M AgriLife Extension Service, and I included this picture to begin my presentation to highlight the importance of the current trade disputes and disruptions and situation that are affecting many markets and economies around the world, and we'll talk about the impact of those specifically on the grain market in the course of this presentation this afternoon. This statue is entitled Man Controlling Trade. It was commissioned in the mid-1930s and giving the economic backdrop that brought about this particular representation of the importance of international trade. You know, in the late 1920s, 2020. Any particular commodity market looks like this. As we look at the factors of the grain market today, we're looking at a couple of things. One of the most price determining factors in this schematic would be that relationship of ending stocks to the other use components. So that stocks to use ratio is a large determinant of our grain prices, particularly when it comes to the corn market. And then as we look at our price outlook for 2020, much of that will come from the lower left-hand portion of that slide. Of course, yield is impossible to predict at this point, but what about area? Are there some market factors that might give us indications of what planted area we might expect for 2020? And that will be influenced by returns from competing crops. And in this case, of course, we're talking about soybeans. And so soybeans in the current trade environment certainly very important. We are in an era of very rapidly strong increasing trends for grain use. World per capita grain consumption has been on this strong uptrend for almost 20 years now. In the early 2000s, we began to increase the amount of barley, corn, millet, mixed grains, oats, rice, sorghum, soybeans, and wheat that we were consuming per capita around the world, and we've been on that trend line now since those late 90s, early 2000s. Much of that, of course, growth could be explained by the use of grain for fuel, and the shaded area on that chart would indicate in the United States when we saw that strongest period of increase of corn for fuel. But we began on this path prior to the passage of the Renewable Fuel Standard. Over that some period of time at which that per capita consumption was leveling off the last couple of years, it's interesting to note that we've seen some leveling off in the world grain trade. Global exports of those same grains that we saw from the previous slides of consumption have leveled off as well. And they've been about flat over the last several years. And certainly these correlate to the current trade disruptions and disputes that we're involved in right now. And those really began to escalate in the latter half of the marketing year 2017-2018. We started to see the impact of that, and you can note that in 2018 particularly, that soybean section of those grain trade exports was significantly smaller, and then we've seen some retraction in the corn market as well for 2019. Looking at the primary contributor of that soybean component certainly are exports to China. And this chart indicates China's net exports. So in other words, these are all net negative numbers. So this could be an import slide for China, in that they are an importer or negative net exporter of the grains and the oilseed that are indicated here, with soybeans being the largest component of that. I think it's interesting to note that in 17 and 18, we're seeing those soybean imports, primarily flat, again, back to the trade situation, but also the problems they're having in their domestic livestock industry and problems with their pork production that's limited their demand when it comes to certain feed grain components. But longer term, the strongest correlation that I can find to explain why we have been on this path of increased grain consumption per capita has been its relationship to gross national incomes per capita. Grain use per capita is the same slide we saw, same line that we saw on the slide a little bit earlier, and here it is the red line. That is that grain use per capita with that little bit of leveling off here in the last couple of years, and then overlay that with growth in national income or average incomes in the nations of the world that are described as developing or emerging economies. And specifically, we're talking about Brazil, Russia, India, China, Mexico, and then a cluster of other Southeastern Asian nations, Indonesia, Vietnam, the Philippines, Thailand, and Malaysia. And when those economies began to grow and expand, another chart of economic growth that makes much the same point, we see represented here is growth in GDP. The world economy combined, that's the green line. The developed or advanced economies, that would be the blue line on this chart. And then those emerging and developing economies that we're just talking about, those would be the red line on the chart. And you can see when those emerging and developing economies began to separate themselves from the rest of the world was in the late 90s and early 2000s. They were growing much more rapidly, and that explains the relationships that we were just talking about. We've seen those economies slowing down considerably 2016, 17, 18, and then some expectation. This is the World Economic Outlook from the International Monetary Fund. Expectation for those economies to pick back up in 2020. Looking then at some more specific price outlook factors when it comes to our grain markets, I'm going to talk about sorghum just a little bit and its importance on High Plains agriculture. Obviously, the price of sorghum is tied to the price of corn. Regardless of its own fundamentals, sorghum is going to follow along with the corn market. But I think it is interesting to note that even though the general relationship is for that sorghum price to be below the price of corn, in other words, sorghum will trade at a discount to the price of corn in most cases, there are times when we see a significant premium that is offered in the sorghum market. They're following along general trend lines together, but we find periods in which sorghum can actually trade at a significant premium to the price of corn. Look at 2007, again over 2015, 16, we've seen fundamentals matter a lot when we're trying to estimate the price of corn. Looking at sorghum and its own fundamentals don't really tell us so much about the price of grain sorghum. Over on the corn chart, the season average farm price is over on the y-axis there on the left, and across the bottom on the x-axis you'll see the stocks to use ratio. And so as stocks to use ratios get tighter for corn, as we move to the left, you can see the influence that has on higher corn prices. And just that single variable, the stocks to use ratio, explains about 83% of the season average farm price when it comes to corn. Grain sorghum is going to follow the corn price regardless of sorghum fundamentals. You can use the same stocks to use ratios for grain sorghum and then the sorghum season average farm prices, and in this case sorghum's own fundamentals. Looking at what our expectations around corn use would be in the next marketing year, demand factors look pretty flat. Exports down over the last couple of years. We're seeing fuel sector is not really growing. The feed sector, not really growing. Food, seed, and industrial use is about flat. We are seeing ending stocks come down a little bit, but we've had smaller corn crops in this country the last couple of years. And now let's look at some of those demand factors. Detail. This chart is really busy and complicated, but I think it makes an important point. First of all, we'll look at the shaded bars. Those are grain consuming animal units. USDA has a measure by which they can convert each livestock species and equate that to a 1,000-pound dairy cow. So whether you're talking about broiler chicks or feeder pigs or feeder steers or whatever it might be, equate those to a dairy cow, and that gives you an animal unit. And the combination of the dairy and cattle industry, of the poultry and the pork industry, gives us all-time record highs. We're up over 100 million grain-consuming animal units, and so that's very positive for feed demand. The largest component of that is still the beef and dairy sectors at about 36% of that total. However, that 36% is an all-time record low. I think this is a very sobering chart when you look at the ethanol industry in the United States. This is motor gasoline consumption. These are estimates from the U.S. Energy Information Administration. They make these every year. And the outlook is for declining gasoline consumption in this country. We saw declines from 2018 compared to 2017, and it looks like 2019 is going to be lower than 2018. And it's interesting, lower gasoline consumption in a time in which the economy is doing pretty well. Gasoline prices are relatively cheap, and we're still using less gasoline. And moving forward, that declining trend is expected to accelerate. And of course, several factors would explain those long-term projections. One is we're driving, as a nation, driving fewer miles. We are driving those. Ethanol production in the last marketing year, 2018-2019, was lower than the 17-18 marketing year, and that's lower for the first time in the biofuel era since 2006, except for the drought of 2012. That year was limited corn supplies, all-time record highs. We did see ethanol production go down that year, but otherwise, this would be the first year-over-year decrease in the ethanol. Exports are down relative to the last several years when we're looking at corn, about down to about 1.85 billion bushels. We've been over 2 billion bushels the last couple of years. And that's discouraging to see those exports coming down. 1.8 billion bushels is actually about average. If you go back to the mid-1970s, that's about an average level of U.S. exports. So it's not below normal, but certainly it's down from some of the higher levels that we've seen the last couple of years. And just looking at when those lower exports have actually kind of played out. If you look at the first quarter of 2019 and the second quarter of 2019, they're on the far right-hand side by quarters, significantly lower than where we were in 2017 and 2018. So we just don't see the export components there in the corn market so far here in 2019. Grain sorghum, it's much more dramatic. Again, the trade disputes with China began to escalate, particularly for grain sorghum. It was early February of 2018. And after that point, exports to China basically just fell off the table, just gone away. We did see some exports going back to Europe, a little bit back to Mexico and Japan, but without China in the market, it's been a whole different world for grain exports when it comes to the grain sorghum. And then back to that spread or the discount, the premium between sorghum and corn. That black line indicates that price difference, the sorghum price minus the corn price. So when those prices are below zero, that's grain sorghum trading at a discount to corn. When those prices are above zero, that's grain sorghum trading at a premium. Overlaying that price series or that difference are actual export sales of grain sorghum. And you can see that in those periods in which we've seen stronger export sales, either that discount is less or we've actually seen premiums in the grain sorghum market relative to corn. Again, back looking at 2007, that was a strong export year to Europe. And then 2014, 15, 16, we saw particularly strong export to China. And we saw then relatively large premiums for grain sorghum in that. Looking at acreage expectations for 2020, there seems to be some strong relationship by how much corn versus soybeans we plant, given soybean to corn price ratios. Along the x-axis there is the soybean to corn base price ratio. This is set by the Risk Management Agency when they set insurance prices in February. When that price ratio of soybeans is relatively high to corn, say that 2.5 range, we see the acreage that are planted between soybeans and corn goes to zero. So relatively high soybean prices, we'll plant as many soybean acres as we plant corn. As that ratio starts to shift to the left, in other words, the price of corn goes up relative to the price of soybeans, now we're planting more corn relative to soybean acres. And in 2019, farmers intended, of course, we got waylaid by the weather in 2019. And so if we see soybean acres bounce back up to around 84 million next year, which would be kind of a normal level of plantings, that gives us some 93 or 94 million acres of corn. Forward. And so the price impact of that, and those numbers may be a little bit small, but I'll be looking at some 93 million acres of corn planted. A normal yield gets us back up to about 176, back compared to the 167, 168 that we're looking at right now for 2019. If that were to play out, we're looking at production of near 15 billion bushels. Add in your carryover stocks, and you're talking about a supply of almost 17 billion bushels of corn, all-time record high, in an era in which we don't see a lot of growth in demand. So given kind of flat levels of demand, we're looking at ending stock carryovers up about 800 million bushels, stocks to ratio not 14%, up to 19%. And I'd be looking at significantly lower corn prices as we come to this point next year. 2018 in October, that futures price. So in terms of market factors for 2020, corn acres up, energy feed use up, but we've got more competition in that space. We're feeding more wheat, we're feeding more grain sorghum. Fuel use, I don't see that going anywhere higher. Exports, depending on global competition, but likely to be down from the last couple of years. Stocks to use ratios higher, prices lower. Still, we have that recession risk in the economy. Trade disputes, certainty around that contributing to that risk. And then, of course, weather being the most significant factor impacting whatever outlook we have. I want to wrap up with just a few comments on the wheat market. And there's several things that are wrong with the wheat market right now. If you look at the long-term price relationships, you would expect Kansas City wheat to trade at about 1.4 times the price of corn. You'd expect Kansas City wheat to trade at a premium to the soft red winter wheat market, which is the Chicago contract, at about 30 cents. Instead, we're looking at Kansas City wheat today trading at about 1.1 times the price of corn. In other words, Kansas City wheat is trading at feed grain prices, not food grain prices. We're looking at Kansas City wheat trading at an 80-cent discount to Chicago wheat. And if we just could return those relationships to normal, leave those other prices where they are, But if Kansas City wheat just traded in its normal relationship to corn, we would be looking at a wheat price of about 532, 1.4 times the 380 corn price. Or take one is the stocks of hard red winter wheat are relatively high compared to corn stocks. And again, the price relationship, that's your y-axis over here, is normally about 1.4. We're currently trading down in that 1.1 range. And I think explaining that is the large level of wheat stocks to use relative to corn stocks to use. So again, using a measure days of use on hand at the end of the marketing year, we've got a carryover of corn of 50-day supply. We're looking at a carryover of hard red winter wheat of a 200-day supply, 4 times the carryover in wheat that we've got in corn. And when you see those relatively large stocks relative to corn, that's when you push down to feed grain prices when it comes to Kansas City wheat. So that's where we are right now. So if we're going to shift out of that, we either need, and then to the differential between hard red winter wheat and soft red winter wheat, that price difference, that's the blue line. Again, over time, that's typically a positive number. And now we're down to some 90 cents discount of hard red winter wheat to soft red winter wheat. And that's been the case for about a year now. To see, not only has it happens from time to time, but now we're in this long-term relationship of what's going on there. Well, if we look at the relative level of hard red winter wheat stocks, again, we've got large levels of hard red winter wheat, in this case, compared to soft red winter wheat. So if I subtract my hard red winter wheat stocks, take the hard red winter wheat stocks minus soft red winter wheat stocks, we've got an abundance of hard red winter wheat now of about 382 million bushels, and that has been growing in the near term. So wheat market factors for 2020, I don't think acres are going to increase next year. They'll stay at all-time record low levels here in the U.S. Use for feed should go up a little bit. Exports, it'll depend on what happens with our global competitors. But if you look at yields next year, if we just take back to normal, that'd be down from the record crop in 2019. And so if acres stay the same and yield just goes back to normal, you're looking at production coming down, use going up a little bit, stocks to use ratios going down, but they're still going to be relatively high. I do think we'll be moving back toward more normal relationships when it comes to corn and Chicago wheat, but we're not going all the way back in 1 year, barring some major production situation. But I do think there is encouragement for prices on wheat, Kansas City wheat, to be moderately higher from current levels. But again, that's all I have today. I appreciate the time and being on the program once again. Please feel free to contact me with any comments, questions, or issues that might help when it comes to grain markets and grain marketing. Thank you all very much.